And I think what we're seeing is now markets focusing on not the rhetoric, which has been very positive from a growth point of view, from a reflation, from a deregulation point of view, but now getting into some of the details of dealing with the Affordable Care Act, the repealing of that, the relationship that Trump will have with Congress. So I think to some extent yesterday reflected, okay, so now we've had the rhetoric. When we get into the reality, is he able to achieve all of the things that he was promising?
That was Goldman Sachs chief Andrew Wilson talking about the brief dip the stock market took on March 23rd as big investors waited on Congress. Most analysts agree that the vote on Trump's revised version of Obamacare was seen by Wall Street as a test of whether or not he'll really be able to deliver on his lofty economic promises, or whether the political hurdles in front of him might just be too high. In fact, we tackled that topic directly on a recent show and also discussed about how the Trump bump so far has been based more on emotion than reality, more on optimism than on actual change. And today, we're going to focus on a growing sentiment among experts that the markets are already prepared for a major directional change, no matter what happens with President Trump. It's time to tune out the hype and focus on the facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. Hi, everyone, and welcome to the Income Generation. I'm David Scranton, your host. Let's take a look at some recent headlines about the markets. Investors haven't been this worried about a market crash in 4 years. 6 warning signs that the stock market could be heading for a crash. An overvalued stock market couldn't withstand any Trump policy failures. Last but certainly not least, the stock market could still crash, and these 2 sectors hint as it's happening sooner rather than later. Now, of course, yes, there are still plenty of optimistic headlines out there also, which isn't surprising when you consider how much of the financial media is directly influenced by Wall Street. But increasingly, in recent weeks, more and more experts have been taking a cautionary tone. On today's show, we're going to talk about some of the reasons why and what it could mean for members of the income generation, those of us over the age of 50. This week's national guest is Adam Mesh, TV personality and founder of his own successful trading group, and the author of Full Contact Trading. Do we see a potential crash in the offing? We'll ask our guest that question and so much more. And as always, I'll be joined by some fellow thought leaders among financial advisors for another edition of the Financial Advisors Roundtable. First, let's take a closer look at why more pessimistic voices have started to rise among the din of Wall Street cheerleaders. After 5 months of giddy optimism, the stock market was issued a bit of a wake-up call recently. As you probably know, the slide was prompted mainly by what happened on Capitol Hill the previous Friday. The Trump administration, working with Republicans and hoping to pass the new health care bill in the House, at least send it to the Senate for further tweaking, failed in their attempt to convince all Republicans to back the bill. That failure clearly dampened the optimistic mood that has reigned on Wall Street since President Trump's election. This first big shot of doubt about President Trump's ability to turn his promises into reality had other impacts. The dollar fell to a 4-month low. U.S. Treasury yields also took a hit, and the interest rate on the 10-year Treasury fell to 2.35%, its lowest level in about a month. Now, if you saw our show last week on interest rates, and I know you did, you know that falling long-term interest rates, if the trend should continue, could create a real problem for the Federal Reserve. They hiked short-term interest rates by 0.25% just recently and want to approve additional rate hikes this year. But if long-term rates don't continue trending upward, or at least stay above the 2.5% mark, it'll be very difficult for them to do so because it could flatten out the yield curve and slow economic progress. The bigger question for now, though, is will all this negativity prove to be just a hiccup, or is it a sign of more negativity to come, where talk of a normal market correction could possibly turn into talk about the next major market crash? To try to answer that question, we'll need to look beyond the timely issues like politics and interest rates. You've heard me say before that investing is indeed all about the details. In fact, successful investors and analysts know just what details to look at when examining market trends. And these usually aren't the same details that get all the attention from Wall Street cheerleaders or from advisors and brokers who have stock-based business models. In fact, most of those ominous headlines I shared at the top of the show are from recent articles that appeared well before Trump's healthcare difficulties within Congress. Here are just a few of the factors many analysts are citing to indicate that a major market correction may just be around the corner. Again, these are details and indicators largely separate from the question we addressed a few weeks ago on the show, can Trump do it? That's still an important issue, of course, but it's not everything. First of all, seasonal trends. You've probably heard the phrase, sell in May and go away. Well, let's face it, May is just around the corner, and the summer months overall are traditionally a rocky time for the stock market. Number two, the Dow Jones Transport Index is down. This index is often seen as a leading indicator of wider stock market movements, and it has fallen 7% in the last 3 weeks. Number three, investors are buying so-called safe haven assets such as gold and U.S. government bonds. When that happens, it often means they're worried about looking for strategies to protect cash against the possibility of a stock market sell-off. Number four, volatility has increased. The VIX index, which measures volatility, is also known as the fear index. The markets are largely driven, as you know, by fear and greed. And when greed is in control, they could soar. But when fear takes over, look out. And five, last but certainly not least, yes, most people agree that stocks are overvalued. In fact, U.S. stocks are considered to be among the most overvalued globally. Now, that last detail is a crucial one related to one of the most important but most frequently overlooked market indicators, price to earnings ratios. I'll talk more about just why that is a bit later on the show. But for right now, we're going to talk more about this overvalued market and some of these other potential warning signs with my guest, Adam Mesh. My guest today, Adam Mesh, is founder of the highly successful Adam Mesh Trading Group, whose mission is based upon discipline, control, and accountability. He's also known for his appearance on the NBC reality show Average Joe and for his acclaimed books Full Contact Trading and The Average Joe's Ultimate Beginner's Guide to the Stock Market. Welcome to the show, Adam Joe.
Thanks so much. Thanks for having me here.
I know you're in the New York studio right now. If you were a little bit more south, I could actually call you Adam Joe and probably have it be realistic, but everybody knows your name's really not Adam Joe. But listen, first of all, the Trump bump. Have you seen the same sense of irrational exuberance that I've been seeing right now in the stock market?
I mean, it's hard to explain how we got here. All of last year seemed surreal in how we went up, and then the expectation was going into the election, if Trump became president, that we'd go down, but then we just continued higher, and now it seems that everybody is bullish.
Yeah, it does seem that way. And have your concerns about the market being high, have they grown after the health care bill got shot down in Congress?
It's just hard to buy up here because everything has come so far already. You know, if you were going to go see Hamilton in New York and you didn't buy tickets because they were $250, would you pay $1,000? It's the same thing right now with the market. Yeah,
and you know, it's interesting because when everybody's on one side of a trade and everyone's bullish, you know, you have to be concerned, and that's what we've been seeing. I know I'll blow the whistle on myself. I didn't see the Trump bump being nearly as big as it was. I mean, was this a surprise to you, or were you telling investors that they can ride some momentum upward, at least between November and now?
As soon as he became president, it became clear that sectors were going wild. And one of the things you saw initially was, and the best example is the financials shot up. They were up around 17% following the election. And now, after the first quarter of 2017, they're actually down a couple of percentage points. So things have been all over the place, but totally surprised at how strong we remained.
Yeah, and were you surprised at seeing what happened to the 10-year Treasury? You know, the Fed raised interest rates a quarter point, and the 10-year Treasury dropped by almost a quarter point. That doesn't make a lot of sense, does it?
That's what comes with uncertainty. You see irrational behavior. The price of gold doesn't do what it's supposed to do. Currencies don't do what they're supposed to do. It's kind of gives you the statement that nobody really knows how to react, and everybody's caught a little bit off guard. I don't think there's anyone that could say they knew this was going to happen.
So which sectors are you telling investors today have more upside in the stock market? Which are your favorites? I know financials seem to have gotten a little bit out of favor, as we mentioned. So which sectors right now do you think have the brightest light?
Tech has remained strong. It had a good first quarter that it's finishing up right now. And with innovation and growth, tech seems a nice place to be, not only for stability, but also for upside. And the sector I'd stay away from would be the retail sector.
Yeah, I agree wholeheartedly on the retail sector. It's one of my biggest concerns. So if you're looking at those sectors, how do you recommend investors get involved with those? Just picking blue chip individual securities, or what's your best recommendation there?
That's a great question. And what we've seen this year is more money flowing into ETFs than ever before. And ETFs are a way of diversifying so you're not tied to an individual stock. So let's say you and I both don't like retail and we want to put a bearish play on. We could do it by trading the XRT, but we wouldn't be exposed to Nordstrom's potentially getting bought or takeover talks about Sears. By being diversified, we could be right on retail without the exposure of an individual stock.
So do you recommend that investors go short if they think that something's overvalued?
I like to use options when I'm looking for bearish plays because that's limited downside and you still have some nice ROI. But yeah, I think there's definitely ways to make money when the market goes down.
Now, do you ever recommend that people just get out of the market and sit on the sidelines for a period of time if things are so uncertain? Or do you feel like there's always some sector that has a lot of upside potential?
That's another really good question. I do webinars every week, and I have hundreds of individual investors on those webinars. And anytime I say I don't feel comfortable, we're just going to sit out this week, they applaud the decision. And they like that. And I think the investors and the experts like to take a breath and just sit on the sidelines for a little bit and see what's going on. And it's okay to say, I don't know what's going to happen here.
Yeah, it's just humility. I mean, let's face it, none of us knows what's going to happen all the time. If we're right 60% of the time, we're considered to be, you're considered to be a good trader if you're right 60% of the time. So, Adam, if you could stay with us just a bit longer, we need to take a quick commercial break right now. And for Income Generation members watching, stay with us. We have a lot more from Adam Mesh. This is fun. This is great. 3, 2, 1. I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Mesh. Welcome back, and thanks again for staying with us, Adam. So hopefully you didn't trademark this, but let me ask you, using your own words, how often, you said that you will tell people to sometimes go to cash and sit in cash when you're unsure about the future in the markets. But the question becomes, how often do you recommend that the average Joe, if you will, makes trades, makes changes in his holdings based upon your strategy, your newsletter?
So I've moved away from day trading, and I encourage others to do the same because you're competing against robots. But if you have that, what I call the little account that could, which is the money that you want to grow to use for vacations, movies, stuff like that, 2 to 3 trades a week with controlled risk, targeting above average ROI is what I feel comfortable with. And it allows for a lifestyle, plus you go after that income every week.
Yeah, it's true. It's when you're trading against the computer, it's kind of like trying to play chess against the computer. Even the grandmasters can't win. So if you're saying this is the little account that's designed for vacation or something, then how do you teach investors to determine the amount of money or the percentage of their assets for which this type of trading is appropriate based upon their age, based upon their goals? I mean, let's talk about that for just a little bit.
So you take an account and you say, okay, this is my risk capital. I'm not going to need it for the rent. I'm not going to need it for any expenses. I'm going to look to trade with this. And ideally you want to have a $25,000 account because that allows for margin. But then what I do is I spend a lot of time going over the exact risk per trade. So if we're talking about options and you're looking at a $1.50 contract, 10 contracts is a $1,500 risk. One contract, your worst case scenario is $150. You allocate accordingly. And I like to see no more than 10% of equity per trade, which might sound like a lot, but when you're using control risk, it's not.
10% of equity per trade. Now, how about overall? Let's just say that there's an average Joe that has about $500,000 invested. Now, some people may say, well, that doesn't sound like an average Joe, but today there are a lot of average folks that are there or maybe even slightly higher. So let's say that average Joe is 50 years old, has $500,000 invested. How much or what range of amounts would you say makes sense for that person to utilize, with which to utilize your trading strategy?
So you have $500,000. I think if you took an account and you took $450,000 of that and had it tracking the market with a mutual fund that's not going to move more than 3 or 4% each year, you could actually beat that with a $25,000 or $50,000 trading account. Because if you're being more aggressive, again with control risk, you're looking at options trades where a couple weeks ago, if you targeted gold, the 117 calls at 98 cents, a day later they're $2. That's over 100% ROI in a couple days on a low risk trade by the terms of you're only risking 98 cents or $1.
Sure.
So I don't think you need a lot of money, and if you get proof of concept, you could snowball it and start to scale up, as I've seen the best traders do. But I wouldn't be taking $500,000 and trading with it. I don't think you need to. I think it would be irresponsible. I'd rather that be the conservative money, and then that account that you're managing for yourself, it could be smaller, but it could actually outperform dollar-wise the bigger account.
Well, and especially in this market, if you think about it, you and I both are concerned that the market's overvalued. So surely you wouldn't recommend that someone put the other $450,000 in a stock mutual fund right now, correct? Because then they can't even protect that money in the way that you could protect the $50,000 account.
Yeah, I think typically you want to put money away a couple times a year, spread out, so that you're not putting it in timing the market or ill timing the market. And then I also have money in bonds, all different kinds of plans. There's money in a savings account, real estate investments. So there's a lot of different ways to go with that. But yeah, I'm not saying to someone today, take $500,000 and go put it in the market. Definitely not. But I think over time, each year I look to put money in my account and grow it. And it's just, as you know, it's just been an anomaly since 2009. We've just gone straight up. So every time you're putting money in each year, you're typically buying higher. We're looking at 8 years of going straight up. So, I mean, if you don't participate, then you're not making anything. And if you do, you feel like you're chasing. So kind of a double-edged sword, which is why I like having my own account too, that I can manage for myself.
Ironically, Adam, I recommend that when I look at this, I would say if somebody wanted to have 20 or 30% in the stock market because they were in their 50s or maybe 60, approaching retirement, getting closer where they want to reduce the risk and buy more bonds and things like that, I'd actually recommend that they put more in your strategy, maybe 20, 25% in your strategy. Because right now, the market's being so high, buy and hold, to me, buy and hold is just a sucker bet. At least the things that you are doing give people a chance through sector rotation and defensive strategies. So I love what you're doing. Keep up the great work, Adam, and thank you so much for being on our show today. I very much appreciate it.
Thanks for having me. It was a lot of fun. I appreciate it.
So with or without a crash, what exactly might you expect from a buy and hold strategy in the coming years? Well, Jack Bogle, founder of Vanguard Funds, has said that the market's overvaluation suggests to him that stocks are poised to deliver no more than 4% per year average annual return over the next decade. Other experts have argued even that might be a little bit overly optimistic of a forecast. Maybe we should look to get Jack Bogle on one of our future shows coming up soon. Some have cited Warren Buffett's well-known Market Cap the GDP measuring stick and its correlation to future 10-year returns in the market. They point out that this gauge currently implies an annualized total return of negative 2.59% for the S&P 500 over the next decade. Even worse. The bottom line here is that even you reject all the potential warning signs, the market's overvaluation alone suggests a pretty dismal future for committed stock investors, crash or no crash. We discussed this a bit on a previous show, where I pointed out that with President Trump's impact already priced into the markets, even if he delivers on his promise of 4% annualized economic growth, the additional positive impact for investors might just be minimal. That impact has already been felt, in other words, based upon all the hope and optimism since Election Day. If, on the other hand, we see his tax plan and budget hit walls the same way his healthcare reform just did, the downside effects are likely to be a lot more severe, particularly if it triggers the next major stock market crash. History suggests the next major market drop will reach at least 35% and could very possibly be as steep as 70%. And it's actual history that gives us another important detail relative to the market's overvaluation that we definitely should pay attention to. I discussed price-earnings ratios before on this show, and it's a detail especially important to this topic. Every stock price has a price-to-earnings ratio, a PE ratio, and so does the overall stock market. It represents the stock market's price per share relative to its average earnings per share. When average stock prices get too high relative to corporate earnings, one of two things have to happen. Either corporate earnings need to increase to grow into the overinflated prices. This, of course, takes a lot of time. Or prices need to shrink to really shrink down into match the new corporate earnings. This can happen a lot more quickly. What's interesting historically, though, is that when average PE ratios for the stock market overall get at or near 30, it seems to serve as a clear sign that we're about to slip into a long-term secular bear market cycle. This happened just before the crash of 2000 that began what I believe is our current long-term bear market cycle. And it happened consistently with every long-term bear market cycle before that. Just as consistently, none of these previous long-term bear market cycles have ended until price-earnings ratios have shrunken back down into the single digits. And as of right now, average PE ratios are still above 20, nowhere near single digits. Ultimately, then, the market's overvaluation right now is telling us two things, neither of which is especially promising for buy and hold investors. One, the market's overinflated and incapable of delivering much, if any, additional growth, even as a best-case scenario. And two, its overinflation relative to price-earnings ratios is another historic indicator that the current long-term secular bear market cycle is probably not over yet, and that another major drop of the stock market is likely still due. Remember, history also tells us that every long-term secular bear market cycle lasts 20 years on average and has at least 3 major market drops inside of it. This particular secular bear market started in 2000 and, as you know, has only had 2 major market drops so far. Coming up in just a bit, I'm going to discuss more about the warning signs and what steps that you can take to protect your hard-earned assets with fellow financial advisors in my Financial Advisors Roundtable. But before that, Miranda is going to break down some of today's important financial headlines. So stay tuned. You're watching The Income Generation. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
And welcome back to The Income Generation. I'm Miranda Kahn. Here is your Newsmax Finance Update, a quick recap of the stories that moved the markets this week. Energy companies led the stock indices mostly higher earlier this week as crude oil prices continued to rise. Congress blocks Obama-era rules that would have put tough restrictions on what media companies like Comcast and Verizon can do with your information. And more Americans bought homes last month as the weather continues to get warmer. Confidence in the housing market also appears to be a factor. British Prime Minister Theresa May officially files for divorce from the EU. She signed the paperwork Wednesday, almost certainly triggering years of negotiations that will test the European Union. May will have 2 years to settle those terms before they go into effect. For more on these stories, visit newsmax.com/finance. I'm Miranda Kahn. Now back to David Scranton and the Income Generation.
Thanks, Miranda. Now that you're all up to date, let's hear from another financial advisor in the field, and in addition, another very special guest to get their insights on today's topic. It's another time for our Financial Advisors Roundtable. Today, I'm joined by Dee Carter, president of the Carter Financial Group in Midland, Texas, with more than 45 years of experience in insurance and financial services. He actually became independent, opened up his own firm in 2001 to specialize in conservative financial management. Thanks for joining us today, Dee.
It's good to be back with you, David.
And we said we have another very special guest there. Our other special guest today on the show is an old friend of Dee's, Elvis Presley. In fact, if you take a look there, right above Dee's head on the wall behind him, you see a picture of Elvis Presley. And today, there you go, and some great collector's guitars that you have. And it's good to have you here today from the great state of Midland in the great country of Texas, Dee. It's always great to have such a good friend on the show.
It's good to be back with you. I enjoy working with you when we get an opportunity like this.
So, since you're in Midland, let's just start with oil. You know, it was interesting. When I was in Midland, it was amazing how, people talk about oil prices, WTI, just like people around the country talk about what the Dow Jones Industrial Average was, or how the basketball games are going, the brackets, and so on and so forth, the NCAA. So let's talk about oil and how oil prices are changing and how you think that's being affected by the markets or interest rates, or how you think it might affect the markets and interest rates.
Well, in fact, we have a billboard downtown in Midland that has nothing on it all day long, except the number of oil wells that are being drilled in the United States, which is somewhere around 800, and how many are being drilled in West Texas, which is like 319. So we have nearly 40% of the drilling operation going on right here in the Permian Basin area. The price of oil affects everything in this area, and obviously the commodity side of the investment situation will affect the interest rates, I think. Oil prices go up and down, fluctuate based on the supply and demand, and right now the oil prices are below $50 a barrel, which means that the supply has outstripped the demand at the present time. But I do believe that what you see in West Texas especially, and perhaps throughout the Southwest, is that people kind of flow with their investment situation, they flow with what they're trying to do with their money, and especially in their retirement planning, with what they're earning in their oil and other investments. But there's a lot of people in West Texas, David, that participate and buy stock in oil companies or have bought into a production situation. So it makes a real difference. We live in a microcosm here.
Yeah, you do, and it's interesting because in lots of the world, especially here in southern Florida, for example, as the stock market goes up, real estate goes up because people feel more affluent. They can sell some holdings. They can go ahead and buy real estate. Right now, it's almost like we're back to 2006, 2007 again, with condominiums, apartments, skyscrapers being built all over southern Florida. And where you are, it's all about oil, right? As oil prices go up, people feel better. They feel like they're going to be making more money, making money consistently. When oil prices go down, people get nervous. So what's the sentiment right now where you are about oil prices in the future? And what's the general sentiment of people? Are they nervous? Are they confident?
Texans are confident. It doesn't matter what's going on. Texans are confident. But right now, what we're seeing is that.
But it's easy. But it's easy to have confidence because all y'all are packing heat down there wherever you go. That's why you're confident. But I'm talking about oil prices.
That's very true. The oil prices right now, they're predicting right now that the oil prices could go within the next 2 years up to around $75 a barrel. Well, that's a 50% rise from where it is today. That's going to make a huge difference in the attitude of the people in West Texas, and I expect more so maybe around the world, because we're seeing a lot of people investing in that particular area. But yeah, it's going to make a positive influence on the entire United States. Sure. As the oil thing grows. I'm seeing a lot of people doing things now that they hadn't done in years.
That's great. And, you know, it's interesting, you just heard Adamesh, the average Joe, talked about his concerns about the market being overvalued. And I know you well enough, and you're a sharp guy, that you share those concerns about the markets being high right now. You know, what are you telling people? How big of a pullback in the markets are you telling people they might be able to expect?
We're looking at, and I use a lot of different indexes or indices to work these things, David. And one of the things we look at a lot is the Shiller Index to see where we are. And right now the Shiller Index is as high. The only time it's been higher than it is today was in 2000. And you recall what happened in 2000. You and I both got into what we're doing now about that same time. And the only time higher than that was 1929. So what we're telling people right now is that while things look good and while things are going seemingly well, you've got to be careful, because it appears that the indexes, most of the indices that we look at, are high, which indicates that we could have anywhere from a 30 to, oh goodness, 50 to 60% drop in stock prices or in the market. And if that happens, they could really get caught out there in a bad situation like they did back in 2003 and in 2008.
Yeah. No, and you're right, the Shiller Index, for our viewers who may or may not remember from last week's show, we did talk about this, and we discussed the fact that the Shiller Index is basically a different version of the price-to-earnings ratio, which we discussed a few minutes ago on this show. And that Shiller Index is basically a cyclically adjusted, or what he calls a CAPE, a C-A-P, cyclically adjusted price-to-earnings ratio. And many believe that that's actually a better indicator than regular price-to-earnings ratios. So we need to take a commercial break in just about a minute or so. Before we do, though, Dee, I'd like you to go ahead and tell us the story about that Elvis painting that's the viewers are seeing right over your head. What's the story to that?
That painting was given to me by a client several years ago, and we discovered with some research that it is an actual original painting and not a print. And then we discovered who the author or the artist was. We checked with them, found out that she had sold this painting to Elvis many years ago. And somehow or another, it got into a garage sale or an estate sale. A lady bought it, another lady bought it. I ended up with it. It's now hanging on my office wall, and it's documented as being an original painting done by an artist who now lives in San Diego, California, who, by the way, would not give me an authorization letter unless I signed over 50% of the royalties to her if I sold it. So it's hanging here in my office where it will stay, and it is well insured, by the way.
That's great. That is great. And I know the guitars that are next to you are guitars, one of which at least is something that you've used personally as an Elvis impersonator. So when we get back from our commercial break, I might just put you on the spot. You know, I know you could sing that there Acapulco stuff that, you know, without the music. That was called Acapulco, I think it is, isn't it?
Yeah, well, it's a cappella, but that's close.
So I might have to just put you on the spot when you come back to see how good you are. I know it's been many, many years, and so it's good to have you here. And stay with us, Dee. We'll be right back. For our viewers, stay with us. We have a lot more words of wisdom from Dee Carter, and also maybe just a little bit of Elvis impersonation to go along with it. Stay with us. We'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Welcome back to the Income Generation. Let's go ahead and bring back my good friend and fellow financial advisor with 45 years of experience in the financial services industry, Dee Carter from Midland, Texas. Thanks for sticking around, Dee.
Glad to be here.
So the most important question I think I have to ask you is, what are your 3 favorite Elvis songs?
Wow, you really brought up something. Well, I tell you what, I can probably tell you that. Suspicious Minds is always a favorite. The American Trilogy always gets a good response when I do it. And probably I want to go 7 Lonely Days and a Dozen Towns Ago. Anyways, one of those songs. Those three are my top three, and I enjoy singing all three of them.
Now, to put you on the spot, okay, without you going to Mexico to sing that Acapulco stuff we were talking about, I'm afraid to go because if Donald Trump puts his fence up, you may not be able to get back, okay? So without going to Mexico, can you give us just a few notes of Suspicious Minds? Let's hear it.
We're caught in a trap. I can't walk out because I love you too much, baby. That's all. After this, you got to pay for it.
That's great. And speaking about traps, we're caught in a trap. You know, the stock market today at record highs could be viewed by many as being caught in a trap. So people have referred to it as a sucker's bet. You know, what are you telling people about the stock market today beside the cyclically adjusted, the Schiller index, they call it? You know, are you telling people still, you know, buy and hold, but with a smaller part of your money? Or are you telling people don't play the game at all, just get out? Are you telling people to invest actively and be an active trader with some small part of their money, as Adam Mesh recommended, our guest just a few minutes ago? Tell our viewers.
Well, actually, what we're looking at, obviously, it depends on the individual and where they are, how old they are, what they're trying to accomplish, if they're looking for growth, if they're looking for retirement, if they're looking for preservation of their estate, whatever it is, we try to figure that into the situation. We know that 60% of the American people think they've got money, but they don't know what they've got. And that's by actual research in the past. 3/4 of that 60% really don't have any idea about fixed income products. They really don't have the education for it. So one of the things we try to do is to educate them about what the market does. I think Warren Buffett had a great line. He talked about if you're going to buy something, you need to buy something that you don't mind holding for at least 10 years in case the market closed for 10 years. And I think that has a lot of sense in it. So what we're telling people is simply this. If you can afford to put your money in a place where you could lose 30 to 50 to 60% of it, perhaps even more, without killing your retirement, then we have some opportunities for you there. But if you're more concerned about long living and living with your money and making sure your money comes through, you might want to take another look at fixed indexed or fixed products and fixed interest products that have been around for a long time, David, but really have been kind of pushed to the back shelf. We're trying to move forward as well.
You're saying don't just blindly follow these 60-40 balanced portfolios that Wall Street likes to push because it's a little bit of everything and they feel comfortable. It's kind of a CYA. You're saying it's okay to take a common sense departure from that financial textbook, because that textbook was written by Wall Street, if you think about it, and use common sense and make sure that your investments fit your goals. Is that what I'm hearing?
That's exactly right. And I have been doing this. You mentioned earlier on in the show that I've been doing this for 45 years. I know I don't look that old, but I am. But it's invariably, I haven't ever had 2 people come in the office, and we have 5 to 6 people a day come through here. I have never had 2 people coming in a row that had the same problems, the same age. I don't have anybody that's got the same birth dates after all these years. It's amazing that has happened that way. But you never really want to give just a cookie cutter type product or program to a group of people. Everybody's got a different situation. I think the main thing we have to do, and it's something that I think is really, really lacking in the financial services industry, is to educate the people as to what is out there and let them find something and work with them to find something that will fit their particular needs and will solve their problems. If they don't recognize these problems, then you really can't solve them.
You know, at the end of the day, as much as you care about your clients, and I happen to know that you care about your clients better than probably almost every other financial advisor I've ever met. But regardless, nobody cares more about your clients' money than your clients themselves. And
Absolutely. That's
just reality. Now, you know, people also say that, you know, the markets have a lot of upside potential left. They might go up another 5, 10, even 20%. In 30 seconds or so that we have before the commercial break, you know, what do you tell those people who say there's another 5, 10, maybe even 20% upside?
Would you risk making 5 to 10 to maybe 15% with the potential of losing 30 to 40 to 50%? Dave, if I walked into a casino and sat down at a table and they said, if you want to bet $20, we'll give you 5 if you win, but we'll take your 20 if you lose, I wouldn't even sit down at the table. So we're trying to get people to understand how that works and to understand exactly what will happen if you're put your money out there in the market was to do what most people now are saying it's going to do.
Again, it's all common sense. It's simple advice. I love it. And we take another commercial break. So, Dee, stick around. Stay with us. We'll talk more about common sense approaches to the stock market, to the financial markets, and to your hard-earned money as an income generation member. We'll be right back. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, and I'm blessed to be here today with the great Dee Carter from Midland, Texas. So Dee, you need to tell me the truth now. Are you wearing your blue suede shoes today?
Today I'm not, but you would have caught me with them on yesterday probably. I do have 2 or 3 pair of blue suede shoes. It comes with the territory, man. What can I tell you?
I know that you've been known to wear them on more than one occasion, so good for you. It's a fair question. I had to ask that. So if you're telling people that from an investment standpoint, it's not worth trying to squeeze the last 5 or 10% out of the markets and maybe lose 20 or more along the way, then what kinds of things are you telling a lot of your clients might just be appropriate for them that might also help protect their money?
If they want to stay in the market, David, we take a look at really high yield bonds. We're looking at that particular situation, maybe perhaps some preferred stocks, but we also look at fixed index products, insured products, all the things across the board that will fit their situation. And invariably, we will come, and mostly income. What we're trying to do is convert people from the idea of growth. They've been working for growth all of their lives, and that's okay. And they've tried to preserve it now, but there's a time when you've got to move into an income mode, and that's what we're trying to move people into. So we look at things that will last them for as long as they last. My question is, do you want to run out of money before you run out of breath? And most people say no. They like to have some money as long as they're alive. So we try to move them into the income mode idea, and there's a number of different ways you can do that, and it really move the risk down to a very controllable level, and that's what we're obviously trying to accomplish.
Isn't it amazing, Dee, that so many people you speak with don't know there's an alternative to crossing your fingers and toes and hoping that there's growth or capital appreciation? I mean, most time people seem to think, hey, the markets are the markets. It's where we should be. And we need to take another commercial break. We come back though, I'm going to talk to you just briefly, ask you briefly about your experience. In fact, let's start right now. In the 30 seconds or so we have left, why don't you tell me, how much it helps you having 45 years of experience in this business, having lived through the bear market in the 1970s, how much that helps you really give wisdom to your client base?
I can look back and see what's taken place, and I know that history is a teacher, and I know what the curves look like. And I know we're at a particular curve potential right now where the market could do a bad thing. But that 45 years tells me that something's going to happen. It's going to happen, I think, soon. And we need to be really careful where we are.
Yeah, if you think about it, if an advisor, generally speaking, has not been in the business now for 37 years, since the 1970s, they either have had to study in great detail market cycles and the effects throughout history, or like yourself, actually have been in the financial industry back in the 70s when you couldn't touch the stock market with a 10-foot pole. Most people didn't want to go anywhere near it. So Dee, please hold on just for one last time. When we return, we'll finish up just talking a little bit more about Dee Carter and about the financial markets and how, from Midland, Texas, how you can protect your money. We'll be right back.
The closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Welcome back to the Income Generation. I'm David Scranton, and let's go one more time to Midland, Texas, to my good friend Dee Carter, 45 years of experience in the industry. Dee, in the 45 seconds or so we have left, tell me, how did you explain to your clients back in 2008 why they lost so much money with the financial crisis? When they were your clients, you were supposed to protect them. How did you explain that to them?
It was one of the most difficult things I've ever done, David, because I was in the market doing it with another company, with a brokerage group, and we had to try to teach them what the market cycles were, and it was very difficult to bring them along. But what we tried to do is educate them. I'm really a believer in education. We educate them as to what the market's doing, and believe it or not, if you'll educate people, if you'll show them what they need to know and help them to learn it, they will follow you and they will work with you as closely as you've ever been had in your life. And that's all we do is educate. We educate.
And there you go. You have it right here, right from the horse's mouth. It's all about experience. At that point, 35 years of experience and still learning lessons that help protect your clients' money. Dee, thanks so much for staying with us till the end of the show.
Happy to be here.
Before we go, I'd like to thank all my guests as well as you, our new and returning viewers. Without a crystal ball, no one can really say where the stock market or the global economy, for that matter, or anything else, is headed in the months ahead. And no one has a crystal ball. The best that we could do is consider all the evidence and make sure that we're focusing on the right details and consider the potential impact of every possible scenario. If you're retired or near retirement, you should be asking yourself, is the upside of hanging on to my riskier investments comparable to the potential downside? Do I have as much to gain as I have to lose by hanging in there and hoping for the best? Or, with the market surpassing all-time highs, ask yourself, has it topped out? And if it has, do I have a lot more to lose? And if so, wouldn't now perhaps be a good time to reduce my risk and start focusing on what should be my #1 priority? As Dee Carter said it best, reliable retirement income. Thanks for watching.